Hey everybody, this is Brent from Wolf on Wall Street Trade with a quarter end market update for you, and we're looking at the NASDAQ-100. We are looking at a quarterly chart, so this is Q1 of 2023. You've been following me, or if you're a subscriber, you know that NASDAQ-100 has been the average that I thought would lead the market in Q1, specifically led by the mega caps. So this is the best quarterly performance, 20.5% for the quarter, which is leading some in the financial media to say that the NASDAQ 100 is now in a new bull market because it's 20% off the lows. I don't agree with that, but still fantastic performance, 20.5%. It's the best in almost 3 years, going back to here, which was Q2 of 2020. So if you remember, Q1 of 2020 was the COVID crash. Q2 2020, the Fed unleashed unprecedented monetary policy easing. The Fed dropped the Fed funds rate down to zero and started buying $120 billion in assets a month. That money went into the market, and we had this really strong performance. So for the NASDAQ to perform this well in the exact opposite environment where the Fed is hiking rates and was rolling off its balance sheet is just really spectacular performance. And this is the second best performance on the quarter, going all the way back to Q1 of 2012. Extraordinary performance from the NASDAQ 100. And now we're looking at a 60-minute chart of the NASDAQ 100, and here is the beginning of the year of January 2023, and we can see just really bullish price action. Huge bull flag. If we take a closer look over here, you'll see a lot of smaller bull flags, which just tells you the price action is very bullish. Here what I've done is add the S&P 500 in blue and normalized it against the NASDAQ 100 year to date. So for 2023 or Q1, and the S&P gained about 7%. So the NASDAQ 100 just about tripled the performance of the S&P 500 for the quarter. Another little fun fact is that this March was the NASDAQ's best March since 2010. I think you're getting the point here. If we come back to this chart of the NASDAQ 100 60-minute chart, and here is the beginning of the year, and we have this massive bull flag. If we take a closer look, I mean, you can see a bull flag here too, but if we take a closer look, like say, let's try a 30-minute chart, you can see a lot of bullish price action. Bull flag right here before it broke out of this larger bull flag, consolidated into another bull flag, broke out. But more importantly, I think, is the fact that as far as like a second leg goes, you know, and we can have a couple different interpretations of a second leg measured move target, conservative or a little bit more liberal. Either way, as far as the second leg goes, the only hang up the NASDAQ had last week was that it hadn't made a new high above this. So now that second leg is underway. We've made that new higher high. So this is another really bullish thing that's gone on for the NASDAQ 100. So the question is, does the NASDAQ 100 stay in a leadership role, in the mega caps in a leadership role as we enter Q2? And we're going to look at that a little bit. But what I would say is that based on the price action, you know, that I just showed you on multiple little time frames, all these bull flags, this doesn't look like an average that is like weakening at all. Now, of course, at the end of a quarter, you get window dressing. So the window dressing is considered like the art of looking smart. So if a fund manager missed this whole ride, right, and it's the end of the quarter, they can buy NASDAQ 100 at the end of the quarter, and when people go and look at their performance, what they owned and all that, they can say, oh wow, they had NASDAQ 100, or they had the mega caps, or whatever was performing really well, even though they may have just bought it in the final week to get it on their prospectus and basically look like they did much better than they did. So that's why they call it the art of looking smart, and that can drive some kind of FOMO year-end or quarter-end flows chasing those best performing assets. Now to deal with the whole, is the NASDAQ 100 in a new bull market? So the reason that is even being brought up is because if we come, if we come off of the low here in December, which was a lot of tax loss selling because these were some of the ugliest stocks in 2022, you can see 23.45% almost, right? So that gives rise to this notion that it's 20% off the lows and oh my gosh, we're in a new bull market. You can probably recall that the Dow actually led this whole rally in October. Let me pull up the Dow real quick. And here's a daily chart of the Dow. So again, it led the first leg of this rally from October, right? And there we go. Had a little double base over here, W bottom, which was really nice looking at the time. 20.4%, and this gave rise to the same kind of claims and calls back then that the Dow's in a new bull market. As you can see, the Dow has done nothing since then, right? I don't see this as a new bull market. The way I look at it has nothing to do with the percentage gain off the lows or the percentage loss off the highs, but actually the primary trend. So if we look at the primary price trend in the NASDAQ, what you will see is that the primary trend over here, this was a bear market, lower lows, lower highs. And then the call was, back in this area, my call was that the market would transition from a primary downtrend, and the downtrend, the primary part, is established by the price action of primary trend, lower highs and lower lows. And my call was an intermediate lateral trend. And we saw that in like small caps first. I think if we pull up IWM, you can see that lateral trend here. So what I see is the NASDAQ, which was the major laggard of 2022, just basically catching up now and doing that same thing and moving into that intermediate lateral trend. That doesn't mean the bull market or the bear market is over. It doesn't mean we're in a new bull market. It means that there's a trend reclassification from primary down to intermediate lateral. If you are one of my subscribers at Wolf on Wall Street Trade, then you know that this has been my expectation since probably, September, October of last year. So this is nothing that strikes me as strange or caught us off guard. This is exactly what we were looking for. We had a really strong close to the end of the week, and we'll take a look at some of the averages. Again, it's the end of the quarter, so there is some window dressing, but there's also portfolio rebalancing, and that's one of the big questions that we're looking at is, does the NASDAQ-100 continue to outperform into the start of Q2, which begins on Monday? I see some really bullish price action that's developed like over the last week or two. So right now we're looking at a 60-minute chart of the S&P 500, which also came into February, right? It had met its measured move target at 4150, exceeded it a little bit, hit 4200, right? And whenever a measured move is hit, like this one, the first thing I expect, or the most probable thing I expect, is a consolidation. And we started that with a bull flag right here, and it looked good, and then poof, S&P fell apart. It did have a chance right here to potentially set up a bear trap or head fake, and you see it kind of started to spring, and then boom, what happened? The bank failures, or the banking crisis, little mini banking crisis. But if we take a closer look, so we see this trend line over here was acting, it's no longer a bull flag, by the way, but these trend lines were still showing that price had a lot of respect for them. So you can see resistance over here. We kind of break above that and then test it. So former resistance became support. This 4,000 level has been like a psychological magnet, been a really strong level. So let's take a little bit closer look. What I see here is definitely an improvement. Like I said, we had resistance here, broke above that, did hit resistance at this upper channel, right? It's no longer a bull flag, so we're just calling this a channel now. Then came back down, found support here. Notice this 4,000 level too, really sticky level. So towards the end of this week, what do? We break out above 4,000, break out above the upper channel, and end at the highs of the day, the highs of the week. So very bullish price action into the end of the quarter. And this is S&P 500. NASDAQ was really the one that smoked every other average. And finally, I want to point out that we ended right above this 4,100 psychological level. Any of these like whole numbers, 4,100, 4,000, they're kind of like psychological magnets. So this is something, we've known about human psychology for a long time. It's why when you go to stores, say Walmart or Target, you don't see stuff on sale for $10. You see it on sale for $9.99. It's that little penny difference that makes all the difference, psychologically speaking, right? So same thing, the human mind just gravitates towards whole numbers. So that is why this is important. Plus you also have, a lot of options and stuff that are going to be at these whole numbers. Here's the daily chart of the S&P 500. I'm not going to get too much into this whole moving average thing, but you have a 50-day here, a 100-day here, a 200-day here, and then we had these trend lines. So all of these moving averages about 2% from each other, and all these important trend lines and 4,000 level and all that, they're all converged in this area. So the breakout above them, and remember this is a daily chart, and this very strong close on Friday. I mean, look at that. It's session highs, big candle. Awesome. I mean, it was really good performance towards the end of the quarter here for the S&P 500. Also for the NASDAQ-100, which really kind of made that definitive breakout above the kind of start where the bull flag kind of started in early February. So again, really nice price action here. There may be some kind of window dressing, chasing prices there into the very end of the quarter, last day they could do it. Even the Dow, which has been just my least favorite, since that first leg of the rally from October to late November, it's been just, I've had no interest in it at all. But even the Dow had a pretty decent close. So you can see the 50-day acting as support here, breaking then. This is just a great example. Matter of fact, let me grab a highlighter real quick. You see that 50-day acting as support here. It's broken right over here, right? So what is the most probable outcome? That former support becomes resistance, which we see right over here. Cannot get back above that 50-day. Have the same thing down here at the 200, and it's just kind of a couple days above it. But in any case, we see better performance here. The Dow has finally broken out above its 50-day, now approaching this 100-day. So even my least favorite average for Q1 of this year had a pretty decent week. Again, the Dow really is the one that led this whole rally that kicked off in October here with this little W base. But that was the extent of it right there. But this is a healthy sign to see rotation. So we saw the Dow lead it, right? And then we saw in Q1 NASDAQ take over. So when you get rotation in a market, it's generally a bullish thing. Again, I don't think we're heading towards a bull market or anything like that. But for this kind of rally off the October lows, I think we're still in it. Here is a 60-minute chart of IWM, or the ETF for the Russell 2000 small caps. So again, kind of like the S&P, as we came into those measured moves, started a bull flag, and that just fell apart. There's a failed breakout, fast reversal to the downside. Small caps have the most exposure to the regional banks. So this is that whole regional bank little mini crisis that we had. So just like the S&P 500, no longer a bull flag, but this trend line was really important. Price continued to respect it. So I'm going to zoom in on that a little bit. And this is a 15-minute chart. So there's the breakdown, and you can see this trend line, resistance there. Didn't quite get it up there to resistance, but again, here, over here. My marker's not keeping up with my brain. Over here. So one positive development was first this kind of SVB bank failure low held. It got tested over here, broke down, but we did get a close that Friday above it, so that held. That was the first positive development. Second positive development, that we are now breaking out above this trend line. And that leads me to a theory or something I'm watching. And what that is, are we possibly looking at kind of like a sloppy inverse head and shoulders forming? I say sloppy. Obviously, the neckline could be drawn in a couple different ways. In real life, these patterns never look like what you see in a textbook, a technical analysis handbook or whatever, where they're cherry-picked examples. But it does look like we have kind of a left shoulder here, a head right over here. And I would say if we do get a pullback over here, this could be very interesting, forming that right shoulder. But in any case, it's something to watch. And what will have to happen for small caps to really take off and start doing better is some confidence in the banks. And nobody seems to want to buy the banks, especially in the quarter end, and say, hey, we had this on our balance sheet in the first quarter, the worst performing crisis asset. But now that we're moving into the new quarter, they have some freedom and ability to go ahead and change their portfolio. So this is the same small cap IWM, but what I did was I added the regional banks, which have a lot of influence in small caps, in the Russell 2000 and IWM, right? So this is the regional bank index, KRE, in blue, and it is normalized as of the left side of this chart, which is December 15th. So you can see tracking, trading pretty much with small caps IWM until we get into SVB failure. So again, you can see why small caps really haven't taken off yet, because they need the banks to show some confidence. The banks haven't done that, but we do have the opportunity for that to happen as we move into Q2. I've mentioned this a couple times that there is a strong possibility or probability for a relief rally in the banks. Now, relief rally is not the same as like, hey, I like the banks a lot, time to buy the banks. Relief rally is just that, a relief rally. I could theorize, hey, maybe we'll get a relief rally into Q2, but I'm going to show you the reasons why that I think there's evidence there that supports it, as long as we get a little bit of change in the risk sentiment tone towards banks. Before I get to that, let me just show you the 3C chart of IWM. So let me pull up a marker again. And what you can see is as we come into the high over here, where that bull flag was supposed to start, or did start and then failed, we can see 3C negatively diverging into that. That's not all that uncommon when we go into like a large consolidation. But you can see tone in 3C really fell off and kind of led small caps lower. But over here in the area of the proposed or potential inverse head and shoulders or some kind of base here, we can see that 3C has improved in here. So that doesn't really necessarily mean much more than we do see some support here. We do see some buyers of this base, but is it enough to drive a breakout and so on and so forth? It tells us that instead of 3C leading lower and saying, yeah, that's really not likely, that there is a decent chance. But getting back to the catalyst is not going to happen without the banks, and specifically those small regional banks that have gotten beaten up so bad. This is why I see a possibility or a potential. So we're looking at the regional banks in the red and green candlesticks, and the white line is the 5/30 yield curve, right? So this is something I was like pounding on the table with my subscribers at Wolf on Wall Street Trade, and I've mentioned it in a couple of videos. The yield curve tends to lead the banks. We can get into the specifics of it, but it's not really important. You can see it, and it was really sharply leading the banks lower. SVB failed, and what had basically been a month of really sharp yield curve flattening leading the banks lower, then SVB failed, and the banks caught down to that yield curve, which took, I mean, this was a really, really sharp amount of flattening. It was like a major red alert. But the banks caught down to that in like 2 or 3 days. And notice since they caught down to that, they haven't gone lower. Now we have the opposite. We've had yield curve steepening, which for the banks in the near term is a supportive factor. Just like the yield curve led them lower here, it's leading them higher here. From a macro perspective, this is not a good signal. And if you watch last weekend's video or live stream, you'll know why, or pretty much any of them in the last couple weeks, you know, as this has sharpened steeply. It is something you see right before a recession. I do see this as an opportunity for the banks to catch up in a relief rally. That would benefit small caps. This is a really interesting chart. So what we are looking at is the regional banks, KRE, and a 5-minute chart of 3C. So really interesting to look at this chart. Let me pull out my marker again. And what I see is really intense distribution into this rally high, and this is coming in to the new year. So I think what you're actually seeing is not so much inside information that SVB was going to fail or anything. I think what you're seeing is the rotation out of a lot of different sectors, mostly defensive early on, and into those mega caps. So that is what I think you're seeing over here. You know, 3C hasn't made a lower low. So basically price caught down to a leading divergence in 3C, which is pretty common. But if we take a closer look at the more recent activity, and we go to this 3-minute chart of KRE and 3C, what you see again is kind of similar to small cap IWM in that once we got down here, we're seeing at least some buying, some support in 3C, and we can see that in price too, the fact that the banks held this low from SVB's failure. I want to show you one more thing, because right now, as we go into the end of the quarter, if you're a hedge fund or you're institutional fund, you're showing what your assets were, what you were holding for the prior quarter, this doesn't look good. If you're in banks, people are going to say you were in the worst performing thing of Q1. So as we move into Q2, it gives them the opportunity to realign their portfolios, but there's definitely some support here. I want to show you one other chart. And what this is, again, is still the regional banks in the red and green candlesticks. And in the white line here is my own equal weighted index of cyclical sectors. Financials are considered cyclical. So you can see the cyclical sectors are starting to outperform here towards the end of the month, towards the end of the quarter. We haven't seen that in banks yet, but that is a little interesting development to keep an eye on. We're also seeing market breadth improve a little bit. So market breadth did take a big hit in Q1, got a lot uglier, and this is something I expected, last year when I said I think mega caps are going to lead. The reason why is you have a dozen or so stocks, these mega caps, that are responsible for almost all the gains. Then you have the vast majority of stocks that don't have their weight, just not performing as well. What that leads to is a deterioration in market breadth or participation amongst, the vast majority of NYSE or NASDAQ composite stocks. So I've got like 30 or so breadth indicators that I track regularly. Then I have whole layouts that have additional ones. But in any case, I'm just going to keep this simple because I don't want to go through all of them. But we're looking at the S&P 500 in the candlesticks here on a 15-minute chart. And we're looking at the McClellan oscillator in white. So what I see here is the October low, right? Right here. Let me grab a different marker actually. So notice at the low in October, we have a positive divergence in the MCO. And then as we come over here, we have a negative divergence into December where we had some poor price performance. And then in that last kind of 2 or 3 weeks of December, a lateral range. And you can see the MCO is showing better breadth participation. And then we get into, the S&P hit the 4150 target. This is the start of the little bull flag. And you can see, again, a negative divergence here. So breadth deteriorating even more with the bank failures over here. Now let's take a closer look at the same chart to see what's been happening more recently. More recently, especially towards the end of this month, what we're starting to see is breadth improve and leading. So if you look at where the S&P was back here at the very start of February, where it hit that first 4150 to 4200 measured move target, you look where the S&P is now, lower, right? Just closed right above 4100. So it's about 100 points off of this level. But look at the MCO here as compared to back there. So we are seeing recent improvement in market breadth, which suggests a couple things to me. One, we're seeing some cyclicals start to outperform a little bit recently, very recently. This could also be indicative of some rotation going from maybe the mega caps into some of these more, what I would call speculative areas, are the ones that have been beaten up the worst, small caps, regional banks, stuff like that. But in any case, we see an improvement in market breadth. So the market is not necessarily 100% dependent on 12 mega cap stocks. And I want to show you one other thing real quick. Again, the S&P 500, the white line is my own most shorted index of stocks. So what you can see really is that the shorts haven't bought it. They've really been all over these banks. So we see the most shorted index way down here, shorting into price strength, right? Which I agree with, usually the right thing to do. You don't want to chase price weakness, but short into price strength. But in any case, my point is that we're kind of at a level here where the shorts are extremely susceptible to a massive short squeeze like we saw over here. So that is something to be keeping an eye out for as well. I think overall conditions are still supportive for the market to rally or to continue to rally or see some rotation. Incredible bond market volatility ever since these banks failed, but I'll show you why I think, we're still in a supportive position there. So if you're a subscriber or have listened to my videos, I've talked about the window of opportunity. So we're looking at the 10-year yield on a 60-minute chart. Remember that yields move opposite of bond prices. This was a really stressful time for the market. These hot data that sent yields sharply higher in February and into March. So my window of opportunity for stocks to rally, as they were consolidating at this point for the most part, was a break of this trend line and basically yields coming down. Now, incredible volatility in the bond market. In fact, if we look at this week, on a 5-minute chart, you can see yields jumped huge on Monday. So this appears to be due to a high level of corporate debt issuance and rate locks. So as the rest of the week goes on, you can see that kind of volatility faded off. But the broader point that I'm making is that we're still, despite all of the volatility, we are still well below this trend line, and yields are kind of just chopping around in a big volatile mess. So this is the window of opportunity. I think as long as yields don't start moving up, above 3.8%, 3.9%, this kind of window of opportunity or tailwind for stocks is still open. Kind of the same thing applies with the US dollar. And I think to give some more substance to that whole idea of that window of opportunity, you can see where, yields start to break down, right? The beginning of March, and we just see the NASDAQ-100 have the best March performance since 2010. Now, there is one asset that I've been looking for some improvement in. It's one of my favorite leading signals. Right now, I'm just going to keep it under wraps. I'm going to show it to you, but I'm going to keep it under wraps because it's just kind of an edge for our subscribers right now, and then we'll get to it later if things go the way I think. But I want to show it to you. And here we see it in white versus the S&P 500, and it's very modest, very minor at first, but it was very evident intraday. Some relative strength, it started acting better. So S&P's down here at session lows in the afternoon. It is making higher low, then starts leading higher into the end of the week. So this is something that I think is very important, and it's something I've been looking for. And I'll just show you the 3C chart of this asset real quick. So here's the asset, here's 3C. You can see 3C over here is just not doing well. It's not looking good for the asset. Over here, a positive divergence and kind of just chopping around with this price range. But this is a fairly productive looking 3C chart. It's not, screaming, but now we're starting to see confirmation on the upside. So this asset that I've been looking to outperform or show signs of it is starting to do that now as we're moving into Q2. And here's the same asset with the 530 yield curve. So you can see the yield curve leading that asset lower. This is a 60-minute chart. But if we zoom in closer here, what we'll see is in recent weeks here, we have the curve having led this asset higher, and now this asset is catching up to the curve. So this is kind of reminiscent of the banks, except the banks haven't started to do this, the catching up to the curve yet. I'm not going to spend too much time on these next two assets, but I do want to point them out because to me they're very reflective of what's going on with the macroeconomic and more actually what's going on with the market's perception of what the Fed will do next, which is really important. Here is gold. So if the Fed stops rolling off their balance sheet and the balance sheet expands, which it has because the banks have been accessing money from the Fed's facilities, gold would be an asset that I would expect to outperform. So if we're looking at gold here, and this is gold futures on a 2-hour chart, you can see this 2000 level. Again, these psychological levels, these whole numbers, 2000. And what we can see is what looks like a bullish, this is going to be perfect drawing, and it's not a perfect price pattern, but a bullish ascending triangle. Okay, so we have a level of support, or actually a level of resistance that's fairly constant, and then we have higher lows as this consolidation develops. So this is a bullish price pattern, and let me give you one more view. Here it is, gold on a 60-minute chart. You can kind of better see this little bullish kind of ascending triangle, and look where it's doing it, right there at 2000. So that's an interesting development. Also, look at the volume here, volume increasing on this breakout, then decreasing over here on the consolidation. It's hard to argue with this chart. It's got to get above 2000, obviously, actually a little bit above that even. This at least tells me, I think, that the market is starting to really price in the end of the Fed's tightening cycle. And if you've been listening to me, you know for the last year and a half, whatever it's been, I have hated Bitcoin. Not hated it, I've had no interest in it. It's just not acted well. But Bitcoin is a really speculative asset as far as investment managers are concerned. So it tends to do the best when there's a lot of liquidity in the system. Now, the Fed has been raising rates and shrinking the balance sheet, which draws liquidity out of the system, which is why I think Bitcoin had been really, really underperforming. But if we look at it now, and this is Bitcoin futures, by the way, on a 2-hour chart, again, you can see something almost similar to gold with a bullish consolidation over here. And look at the whole level 28,000 right there. It'd have to break out actually above 29,000. A couple different ways you could view this. I guess you could look at it as a bull flag over here that's already broken out, or you could look at it as kind of similar to gold with something of an ascending triangle that's forming. Either way, it looks bullish. You see the volume coming down over here into the consolidation. That's a good sign as well. I'm not really bringing these up so much as like, hey, I love Bitcoin or hey, I love gold. I'm bringing them up to say that these are assets that are acting like they're expecting the Fed to end its tightening cycle soon. These two assets are kind of known as like the QE trade, and we're in QT right now, quantitative tightening, QE, quantitative easing. So with Monday, as we move into the new quarter, start of April, the questions on my mind are, does the NASDAQ-100 continue to outperform, or do we start to see some rotation out of that? I kind of expected it to outperform for a quarter, so we're done with that quarter. But when I look at the price action, it's really, really hard to see anything that's negative about this or suggest that there's rotation out. There is some price action here that suggests that there was some window dressing and chasing the best performing assets of the quarter towards the end of the quarter. But so that's going to be a question because these are very influential stocks. If we go by the measured move of this large bull flag, which we are just starting the second leg of since we broke out first here and then above the February high right over here. If we go by that measured move, and then there's a couple different ways to look at it, the answer would be yes, NASDAQ-100 has more to go on the upside. I would not be betting against it at this point, but I do want to see if we see any kind of portfolio rebalancing rotation out of those stocks, and we'll probably see that in the first week or so of the new quarter, so be paying attention to that. Next question is, do the banks, and especially these regional banks, you can watch KRE, do they rally? Do they get that relief rally? And again, the reason why I even suspect that is because of the yield curve, which led them lower, pulled them lower, and now it's leading them higher. I still view this as a speculative trade, but I think if we are going to see that relief rally, it will be in Q2 and probably fairly early on in Q2. If we do see some strength in the banks, who's going to benefit the most from that? That would be the small caps. And don't forget that the small caps also have the potential of benefiting from a short squeeze in that most shorted index. Small caps are almost always the average that is affected the most by the most short index. So if it's going down or if it's getting a squeeze, they are going to get the most bang for the buck or the most movement from that. And if we take a look at IWM's volume, what I was looking for over here was capitulation, like a capitulation event, seller's event, and we get it here. And we see volume come down over here right into this head, potential head of an inverse head and shoulders. And then as price is rallying up to the potential neckline or thereabouts, we see volume starting to come up. So from a volume perspective, this doesn't look bad as a potential base too. So IWM small caps could see some rotation in Q2 driven by the banks and short sellers being squeezed. From kind of my big picture perspective, I've outlined 3 phases that I think we're going to see, or that we are seeing. Phase 1 is the market has a relief rally, which I believe started in October of last year, to the idea of the Fed slowing down, hitting peak inflation, hitting peak Fed hawkishness, and ultimately into that pivot where they end rate cut. From the last I heard or looked, the probabilities for a 25 basis point rate hike in May for the Fed is basically a coin toss between that and nothing, which would be pausing or ending the rate hike cycle. I think if that happens, it'll kind of be like, buy the rumor, sell the news kind of thing, and this phase one rally will be over. There's some data to support that. So Friday we got the PCE index, and it slowed to a 5% year-over-year gain from 5.3%. 5% for February, that was just reported Friday, and 5.3% for January. The Fed's preferred gauge of inflation is in this PCE report, the core PCE, and it came down modestly from 4.7 to 4.6, but there's still a lot of Fed rate hikes that are in the pipeline. There's about a 6-month policy lag, so those will start to put more pressure on the economy, and it's probable that you'll see inflation continue to come down, which will help the Fed end the rate hike cycle, because the next thing in phase two of my 3 phases is recession, and that's where I think we'll see the market probably make new lows. And just in case you're interested, phase 3 would be the actual market bottom, the end of the, not necessarily the end of the recession, because often the market will bottom before the end of a recession, but basically the end of the bear market and the start of a new economic expansion is phase 3. I think we're still a ways away from that. We haven't gotten to stage 2 recession yet. So in summary, things on my radar as we go into Q2 on Monday: does the NASDAQ-100 and mega caps continue to lead? And from this big bull flag, it suggests that we do have a lot more upside. And from a look at, sorry about that, the more recent action, bull flags, this is bullish price action. There's no two ways about it. I suspect yes, but I also suspect there might be a chance that we see some money leak out into those banks and into small caps. So that's the other thing I'm wondering. Are we going to see the banks get that relief rally? I think it could be very sharp, very strong rally, squeeze a lot of shorts. It could send IWM small caps sharply higher, but I do not think the banks have stabilized and it's all over. I would just expect it to be a relief rally. So let's leave it there. We know what we're looking for as we enter next week. Some of these questions, and I suspect we'll get some of the answers. It's probably time for a little bit of a consolidation here in the NASDAQ. But again, we'll watch it and see if we get another bull flag. We'll keep an eye on those banks. It's going to be an interesting Q2, and I think Q2 may be the end of my phase 1 whole. The market rallies on a less hawkish Fed. If you have any questions or comments, please feel free to leave those down in the comments section. I'll try to answer them. I have all my information on the website and my Twitter account, all that in the video description. If you like the video, please give it a thumbs up. Don't forget to subscribe, and don't forget to click the little bell so you know you get alerts when I'm doing my next live stream, which will probably be next weekend, or videos like this. Thanks a lot, everybody. Feel free to share them too. I appreciate you. Have a fantastic week.